Hey guys, how's it going? I hope you're keeping well during this pandemic. Welcome back for another video. If you're here for the first time, it is truly a pleasure to have you guys. My passion is to make you guys aware of benefits of investing and make you guys understand that investing is not difficult at all. In fact, it is really simple. I already posted a video about how to start saving and investing in 2020. You will find the link in the description below. I highly recommend watching that video to get a basic idea of how to invest and save and various options available to you. And today, let's talk about what to do when you have made the profit and you want to sell your stocks. For example, let's say you bought a share of Tesla for $300 back in 2019 and now it is close to $1,500 and you want to book the profit. So in that case, to make the judgment of whether to sell and what happens when you sell a stock of a company, how much you are taxed, let's cover that in this video. There is a lot of confusion and questions when you're selling your stocks, like how much tax do I owe, how that tax is calculated, and what is it called. So today let's talk about that topic. Taxes when you're selling your stocks is called capital gains tax, and that's the topic for this video. To make this content easier to understand, I'm experimenting with new way of creating the video. It's an animation based doodly video, and if you appreciate this content, please like this video. We will also cover in this video few very important aspects of capital gains tax, like what is the difference between long-term and short-term taxes, what happens when you sell your stocks, how capital gains are calculated, and how to minimize capital gains taxes. When I came to know about capital gains taxes, it truly changed my investing approach. Let's uncover all those questions and give you guys an idea about taxes when you sell your stocks. First of all, what is capital gains tax? To put it in simple words, whenever you make profit by selling your stocks, property, or any other assets, you need to pay some money to the government as tax on your realized gains or profits. It could be as low as 10% and as high as 37% as of 2020. Since it is a tax being applied to a capital gain, it is appropriately known as capital gains tax. And you will need to pay that when you file your taxes, unlike employment or salary based taxes that you pay with every paycheck. Okay, let's take an example. If you buy a share for $100 of company A and sell it for $200, you made a profit of $100. Simple math, stay with me, it is really simple. So in the best case scenario, with 10% tax, you will owe $10 to IRS versus $37 in the worst case scenario. So let's look at how we get closer to the best case scenario and avoid paying share of your profit to government. It is a step-by-step information. So to make you understand this, let's talk about short-term versus long-term capital gains and how this is the biggest variable that can affect your tax percentage. You can find all the detailed information from a trusted source on this link. This video is for information purpose only, and please make your own judgment after doing research when exploring any of the options. Short-term capital gains tax is a tax on profits from the sale of an asset held for 1 year or less. The short-term capital gains tax rate equals your ordinary income tax rate, your tax bracket in short. Long-term capital gains tax is a tax on profits from the sale of an asset held for more than a year. The long-term capital gain tax is 0%, 15% or 20% depending on your taxable income and filing status. They are generally lower than short-term capital gains tax rates. This table shows you the long-term capital gains tax rate based on your income. So it is 0% if your income is between $0 and $40,000 yearly. It is 15% if your income is between $40,001 to $441,000, and it is 20% if your income is higher than that. Let's talk about a very important topic, how capital gains taxes are calculated. Capital gains taxes can only apply on investments such as stocks or bonds, real estates, though usually not your home, cars, boats, and other tangible items. The money you make on the sale of any of the items is your capital gain. Money you lose is a capital loss. The difference between your capital gains and your capital losses is called your net capital gain. You can invest capital losses to offset gains. For example, if you sold a stock for a $10,000 profit this year and sold another at $4,000 loss, you will be taxed on capital gains of $6,000. If your losses exceeds your gains, you can deduct the difference on your tax return up to $3,000 per year. You can include your capital gain in your income to figure out what tax rate applies to the capital gain. Capital gains taxes are progressive, similar to income taxes. So now you have understood how these capital gains taxes are calculated. Let's talk about a very important topic, how to minimize capital gains taxes. There are a lot of strategies to minimize the tax exposure, and some of them could get really complicated. For the context of this video, I'll cover few simple ones that are easy to understand and implement. First one is hold on. Whenever possible, hold an asset for a year or longer so you can qualify for the long-term capital gains tax rate. Since it's significantly lower than the short-term capital gains tax rate for most assets, another strategy to minimize your capital gains tax is rebalance the dividends. Rather than reinvesting dividends in the investment that paid them, rebalance by putting that money into your underperforming investments. Typically, you would rebalance by selling securities that are doing well and putting that money into those that are underperforming. But using dividends to invest in underperforming assets will allow you to avoid selling strong performers and thus avoid capital gains that would come from that sale. Thank you so much for watching this video, guys. If you like the content of this video, please give it a like and please consider subscribing to this channel for more such content. Thank you so much and please don't forget to exercise today.